Hello and welcome. In our last video, we discussed the impacts of the new tax law and the tax liability of self-employed individuals and those on paid employment. In this lecture, we will walk through the key changes introduced by the new Tax Act, NTA, that affect companies' income tax, CIT, capital gains tax, CGT, value-added tax, VAT, and withholding tax. We will summarize the reforms, explain the practical implications, and highlight the compliance and planning actions companies and advisors should consider. Companies' income tax, CIT. What changed? 1. Small company exemption. Companies with annual gross turnover of 100 million naira or less, previously 25 million naira, and total fixed assets not exceeding 250 million naira are now exempt from CIT. This is a significant upward relaxation aimed at small businesses. 2. Development Levy. A new development levy of 4% is charged on assessable profits, defined as tax profits before deducting tax depreciation and losses. This consolidates the tertiary education tax, IT levy, Nasani, and police trust fund levies into a single charge. Small companies, as defined above, are exempt. 3. Minimum effective tax rate, ETR. Large enterprises are subject to a 15% minimum ETR. It applies where the multinational group aggregate turnover is 750 million euro, or where an entity's annual turnover is 50 billion naira and above. The ETR is applied to net income, profits before tax excluding franked investment income and unrealized gains/losses. Nigerian parents of groups must pay top-up tax if subsidiaries in Nigeria have paid below 15%. 4. Controlled Foreign Company, CFC. Rules. Undistributed profits of foreign subsidiaries controlled by Nigerian companies may be taxed in Nigeria if the subsidiary could have distributed dividends without harming its business operations. 5. Free zone and incentives. Free zone companies continue to enjoy exemptions on exports, but where more than 25% of sales are to the customs territory, proportionate tax applies. From January 1, 2028, full profits will be taxable if such sales occur. The Pioneer Tax Holiday is replaced by an Economic Development Incentive, ED, a tax credit of 5% per year for 5 years on qualifying capital expenditure purchased within 5 years from production start, with a 5-year carry forward for unused credits. 6. A large multinational subsidiary with net income pre-tax of 100 million naira that paid only 10 million naira tax, 10% ETR, would face an additional top-up to reach 15% ETR, i.e., extra tax equal to 5% of net income, unless relief applies under group rules or treaties. For instance, a mid-sized trading company with turnover 90 million naira will now be outside CIT, no CIT charge, and exempt from the development levy, provided its fixed assets remain below 250 million naira. This reduces the compliance and cash tax burden for many SMEs. Capital gains tax, CGT. What changed? 1. Rate increase. CGT for companies has risen from 10% to 30%, aligning it to the CIT rate and reducing the incentive to recharacterize trading income as capital gains. For individuals, capital gains will be taxed using the progressive income tax bands applicable to the person. 2. Indirect transfers. CGT is now explicitly triggered on indirect transfers of shares in Nigerian companies. For example, sales of shares in offshore holding companies that effectively transfer underlying Nigerian assets, subject to treaty exemptions. 3. Thresholds. Small companies are exempt from CGT as noted above. The tax exemption threshold for the sale of shares in Nigerian companies has been increased from 100 million naira to 150 million naira in any 12 consecutive months, provided that the gains do not exceed 10 million naira. Practical implications and examples. 1. Company CGT now matches CIT. If a company recognizes a capital gain of 100 million naira, CGT at 30% yields 30 million in tax, materially higher than the prior 10% level. 2. Indirect transfer risk. A foreign holding company sale that results in an effective transfer of Nigerian shareholding can trigger CGT in Nigeria, even if the transaction happens offshore. Where a seller thinks a treaty exemption applies, documentation and legal advice are essential. 3. Threshold example. Sales proceeds on shares sold over 12 months of 160 million naira may still be exempt only if gains do not exceed 10 million naira. The interplay of proceeds versus gain must be carefully documented. Value-added tax, VAT. What changed? 1. VAT rate. The VAT rate remains at 7.5%, but several structural changes are significant. 2. Input VAT recovery. The NTA codifies global VAT principles and permits businesses to claim input VAT on all purchases, including services and fixed assets, provided the inputs are directly related to VATable supplies. This is a major modernization. 3. Expanded zero rating. The list of zero-rated goods and services is broadened to include basic food items, medical and pharmaceutical products, educational books and materials, electricity generation and transmission services, medical equipment and services, tuition fees, exports, excluding oil gas exports, and others. Because zero-rated supplies permit input VAT recovery, affected sectors should be able to reclaim VAT on inputs. 4. Fiscalization and e-invoicing. VAT fiscalization rules and mandatory e-invoicing are now codified. Businesses must implement the tax authority's fiscalization system for VAT collection and invoicing. 5. VAT revenue sharing. The sharing formula changes. Federal government share reduced from 15% to 10%. States 55%. Local government areas 35%. The state/local allocation is further split. 50% equal division, 20% by population, 30% by place of consumption. Practical implications and examples. 1. Input recovery benefit. A manufacturer investing 100 million naira in plant and incurring 7.5 million naira VAT on inputs can now claim that input VAT credit where the inputs relate to taxable supplies, improving working capital and lowering effective VAT costs. 2. Zero-rate flows. Health, education, and some basic food suppliers that sell zero-rated items can now recover VAT on inputs. This requires strict compliance, proper invoices, e-invoicing, and linkage to taxable or zero-rated outputs. 3. Fiscalization. Mandatory e-invoicing will require systems changes, integration with tax authority platforms, and process updates. Failure to comply will attract penalties. Withholding tax. With wage and non-resident taxation, what changed? 1. Broadened scope of taxable activities for non-residents. The NTA expands the activities that can create taxable presence for non-residents. Important is the introduction of force of attraction rules, whereby certain activities performed by related parties or outside a physical P can be taxed as part of a non-resident's Nigerian P. Profits from engineering, procurement, and construction (EPC) contracts can be taxed in Nigeria even if some activities are performed under separate contracts or outside Nigeria. 2. Minimum tax for non-residents. Non-resident companies with a taxable presence will be subject to minimum tax based on the ratio of EBIT to total income from Nigeria. However, tax payable cannot be less than the applicable WAT rate on the income or 4% of the income, effectively a floor. 3. WAT floor interaction. This means WAT remains an important collection mechanism and may represent the minimum effective tax on certain cross-border payments. Practical implications and examples. 1. Force of attraction. A foreign contractor doing consulting via a related company in country or arranging subcontracts outside Nigeria may still be taxed on a portion of profits in Nigeria under the new rules. Tax structuring that previously relied on physical separation will be under review. 2. Minimum tax floor example. If a non-resident generates 100 million naira income subject to OTD at 5%, 5 million naira, but the computed minimum tax based on EBIT ratio would give less than naira 5 meters, the tax payable cannot be less than 5 million naira. Similarly, the 4% floor means at least 4 million naira in tax if that is higher than the computed minimum. Compliance, penalties, and dispute resolution. 1. The NTA significantly increases penalties for non-compliance. Failure to file returns now attracts 100,000 naira in the first month and 50,000 naira for each continuing month. New heavy penalties exist for hiring non-tax registered contractors, 5 million naira, obstructing access for fiscalization, inducing tax officers, and other misconduct. 2. Disclosure. There is a new requirement to disclose tax planning arrangements that provide a tax advantage. 3. Institutions. The Federal Inland Revenue Service becomes the Nigeria Revenue Service, INRS, and state internal revenue services become autonomous. A tax ombuds office is created to assist taxpayers and arbitrate complaints. So, what are the key takeaways? 1. Small businesses benefit from a much higher small company threshold and are exempt from SIT, CGT, and the Development Levy, easing compliance for many SMEs. 2. Companies face higher CGT, 30%, and a new 4% development levy on assessable profits. 3. Large and multinational groups must model a 15% minimum ETR and watch for top-up liability. 4. CFC, indirect transfer and force of attraction. Rules tighten anti-avoidance for outbound structures and non-resident activities. 5. VAT modernization, input recovery, expanded zero rating, and mandatory e-invoicing can improve input tax refunds but require system and process upgrades. 6. What remains a powerful collection tool and a floor for minimum tax for non-residents. 7. Penalties and disclosure requirements have increased, so compliance and documentation are now even more essential. Thank you for listening. For those preparing detailed tax impact assessments or restructuring plans, consult with your tax advisor.